Welcome back to the channel. My name is Steven. I'm a pharmacist and I own 52 units of real estate. So today I want to talk about how I implemented the BRRRR strategy on my 20 unit apartment complex and was able to pull out maybe $80,000 out of the deal and left about $120,000 in the deal. So it wasn't a home run, but it's definitely a base hit. And so let me kind of talk about how I found the property first, how I renovate it, how I stabilize it, and how the cash out refinance process went. Right. So for me, so I bought this off market using my direct mail campaign. I basically sent out a bunch of letters all across Oklahoma, and the owner reached out to me on this 20 unit apartment complex in Enid, and he basically wanted tax assessed price on the property, which was about 420K. And to me, being in California, to get a 20 unit for 420K is insane. So I just said, all right, well, let me underwrite this deal. So I sent it to my lender, and basically most lenders didn't like that deal until I brought the deal to kind of a hard money private lender, and they liked the deal, they liked the potential, and basically that they would finance this, assuming that I bought it at 350K, which is 70K less than what the owner wanted. So what I did was I got a pre-approval letter from the bank stating that they will pre-approve me at 25% down at a purchase price of 350K. Showed that as proof, submitted that with my letter of intent. The owner signed it, and then basically I drafted up the purchase and sale agreement to have the owner sign as well. Right? So basically I bought this for 350K, and I was going to put in $100,000 of renovation to fix up a lot of the units. There was one unit that was completely burned down, which was going to cost me about $30,000. There was an electrical panel that was not to code and needed to be updated. There were other units that needed new flooring, and I ended up renovating like most of the units, right? So and I was gonna bake the rehab into the loan as well. So what I had to do is I had to front the money first, and let's just say I renovated the burned down unit for 30,000. I would then basically hire the inspector. They would come inspect it and then certify that yes, the renovation is complete, and then I'd get reimbursed the $30,000. But then that would be added to my loan. So I bought this with a loan, a hard money loan. I think my interest rate was 9% a month, or 9% interest rate, and basically I had a 12 months to really fix up this unit, right, and basically implement my value add strategy. So what happened was when I took over the property, so initially there were only I think like 5 vacant units. So one was burned down and the other 4 just moved out, and they had no flooring in it because of bed bugs. So obviously I'm still dealing with bed bugs to this day, unfortunately. But basically just knew I'd come in, add some LVP flooring, which I knew cost me around like $1,500, $2,000 per unit. So I thought it was gonna be a quick and easy renovation, right? But what ended up happening was like at one point I dipped down to like I think 7 were occupied out of 20 because tenants were just leaving left and right, and the property managers thought that I wanted to renovate everything, which was a miscommunication on my part. But it ended up working out because I ended up renovating all those units anyways. So some I would do full renovation on them, and some I just would, on average, I think I spent like $5,000 to renovate each unit, which typically included new LVP flooring. If the kitchen was usable, I would repaint the kitchen cabinets and replace the countertops. If it needed a new kitchen, I got shaker cabinets, or the contractor, he actually had a connection with wood cabinets, and he got them at a good price so that I could do wood cabinets for the kitchen, which lasts a little bit longer. And basically he would renovate the kitchen. He'd rip out the bathtub, put a new bathtub. If the bathtub was still good, he would resurface them. So basically on average we spend about $5,000 to renovate each one, right? So if you have 20 units, that's going to cost 100,000. But I think I all in put about, I want to say like 120 to 150K, because I ended up renovating more than I expected. Like I think at a high level, I fixed that burn down unit, which costed me 30K. I fixed the electrical panel, which cost me 20K. I repainted the exterior and the doors, which cost me 10K. I renovated a bunch of the units. So I think I was all in for about like, I want to say, I used to know the numbers, about 120K, right? And I put about $8,000 down in the deal, and basically I was all in for 200K, right? And so after that, I basically was speed rushing renovating these units. So what was interesting was my contractor had a subcontractors underneath him, but I guess the subcontractors were not good. So what he ended up having to do was he fired all his subs and he just started renovating everything himself because he's very detail oriented. Like he's a little bit more expensive than most contractors, but he was very fast, he was very efficient, and he was good at what he did. Right. So I was paying a premium for quality and speed. Right. So you can't have it cheap, fast, and high quality, right? That's typically hard to achieve. But basically, he renovated the units, and he was pretty fast. Like he was renovating these units like um, maybe 2, 3, or 4 a month, right? And for me, I was under the gun of a hard money loan. So what ended up happening was we renovated a bunch of the units, and then we started renting out a bunch of units, right? So I went from 17 of 20, and I think I maybe have like 5 of my original tenants that came with the property, and then after that, it's been like new tenants since, right? Because we renovated the units and rented it out at market rent, which is about 500 to 550 now. And now we just hit 100% occupancy, so all 2020. But whenever lease renewals come, people will leave and new people will come in, right? So it's a continue revolving door. So after that, it took me about 15 months to execute my cash out refinance. And the reason for that was I bought this in May of 2022. And as we know, I started so my loan was due in May of 2023. And that's when interest rates were really going up high. That's when mortgage rates were skyrocketing to combat inflation. And that's when the mortgage interest rate, lenders were very uncertain, right? So I had a very difficult cash out refinance. Obviously, with interest rates going up, keep in mind my hard money loan was 9%, and I was getting quoted like 7 to 9% from. I think I was quoted 9% conventional loan from a private money lender, at 9%, ironically, and I ended up locking in a 6.5% interest rate through Bank of the West because I had a relationship with them. And that process took me 3 months. Like that was the hardest loan I had to deal with because of the uncertainty of the interest rates, and it was so like it was changing day by day. The underwriting was a lot more strict. It was a lot more rigid, and they lost a lot of flexibility. So because of that, it took me 3 months to execute my cash out refinance. And because of the high interest rates, the cap rates expanded. So I think that market that I bought in went from like an 8.5 cap to a 10 cap. So obviously my appraised value was a lot less than I anticipated. So I thought this was going to appraise for $700,000, $800,000, right? And what it ended up appraising at was 520K, which was 180K less than what I anticipated because I was kind of expecting like an 8.5 cap, not a 10 cap, but because interest rates were like 8% at that point, they had to make the cap rates higher than that for it to make sense. So I just said, you know what, it's okay. I plan on holding this long term, so I'll just take my 6.5% interest rate because it was appraised at 520K. I did a 75% loan to value, so I ended up getting about $80,000. I think I was able to pull out at closing. So I put in, keep in mind, about 200K roughly. So I pulled out 80K. So I had left 120K in the deal. Had it appraised at $700,000, $800,000, it probably would have been a perfect BRRRR. I probably would have pulled all my money out, to be honest. But that's assuming that interest rates were at 4 to 4.5%, but it went up to 6.5 to 8%, right? So that's what I mean by real estate's a long-term game. It went from being a perfect BRRRR to leaving about half my money in the deal, and it's not the end of the world, right? Because I have a 6.5% interest rate. Honestly, when interest rates drop, whenever that happens in 2-3 years, I locked this for like I think like 10 years. So it's been about over a year now, so I have like 9 more years, and when interest rates drop to like 4 to 5%, I'm gonna do another refinance, probably pull out the other 120K that I left in the deal, right? And during that window, my rents have been going up, and hopefully expenses kind of stay the same, which is not the case, hasn't been the case. But that's basically what I went through. So it was a hard loan and during a hard time for lenders, right? So it took me like 3 months. So I started the cash out refinance process back in May, because what happened was literally, I think in a span in 1 month. I think in May, I literally rented out like, I want to say like 6 units. My property manager went crazy and rented out like 6 units, right? And what they did was they would stagger the leases. So like they'd be a 12-month lease, a 13-month, 14-month, 15-month, so that all the leases don't expire at the same time, right? But I think at one point I was like, in March, I was like maybe 13 out of 20. And then all of a sudden, like in April to May, I rate into June even. I think I was able to rent out like 6 more units, which brought me up to like 18 or 19 out of 20 renovated. But obviously, people leave too, right? So it's kind of like I gained two, lost one, I net one tenant. So I did a cash out refinance, and now I own this. And this property, cash flows about $1,000 to $2,000 a month, depending on the expenses. But keep in mind, I just did like a huge bed bug spray, which cost me $10,000. So even if I made $2,000 a month, that wiped out 5 months of cash flow. So I kind of call this property a break even. And once basically the rents go up over time, and then I can lower my interest rate, I think it'll cash flow a lot better. But right now, I don't expect it to make money. I just expect it to kind of break even for the most part. Maybe I put money in the deal, maybe it pays me a little bit, but if overall net it breaks even, I'm happy with the deal. So right now, it's 100% occupied, and I'm getting about $10,000 a month in gross rents. And half goes to expenses on average, so it's 5,000. And then you minus my loan, which is about 2,500. So typically am cash flowing about 2,000. But like I said, if I have a $10,000 expense, boom, I just lost like 5 months of cash flow. So anyways, hopefully you learned from my story of going through my BRRRR on my 20-unit apartment complex. It took me a little bit longer than I expected. It took me more money than I expected, and the appraised value was lower than I expected, and interest rates were a lot higher than I expected. So it was kind of a perfect storm of things going wrong. But because I bought the property off market of instant equity day one, and I bought this property of instant equity, and because I have a long-term view of real estate, it's mitigating my risk, right? So yes, I'm not cash flowing much now, but once I can lower my interest rate and once the rents go up over time, that's when the property will start to cash flow. I did leave half my money in the deal, which is okay, right? Like it's a 6.5% interest rate. I want to leave more money in the deal because 6.5% interest, it's pretty high, right? Like relative to like 4%. If it's 4%, whatever, take your time paying it off. If it's 6.5%, maybe you want to expedite paying it off, right? So I don't mind leaving the money in the deal, and eventually in the next 2, 3, 4 years when interest rates lower, I'm gonna do another refinance, lower my rate, and probably pull out the rest of the money. And there you go. It's a perfect BRRRR. It just took me longer, right? But keep in mind, everything went wrong, right? Like from my pro forma, the renovation cost more. The interest rate went up a lot higher than I expected. The cap rate went higher than expected, which lowered my appraised value, right? So despite that, I still think it's a good deal, right? It's a good deal. Like where else could you buy a 20-unit apartment complex for, $500,000, kind of all in? So hopefully you found value from this video. Let me know if you have any comments or questions. If you want to buy your first apartment complex with some guidance, consider checking out my mentorship program. Link in the description down below. Please let me know if you have any questions. I love to answer your questions in videos. And please like, comment, subscribe, and share this video with somebody who is looking to do BRRRR for multifamily. Hope to see you in the next one. Thank you so much.